Well, welcome back, everyone. It's been an exceptional day in markets after last night's gap up on the good news that there's going to be peace in the Middle East, or supposedly there is. We'll get that official on Friday, but the market is working towards it with a gap up and a move higher. The primary market, the S&P E-minis on a daily candlestick chart, as you can see, going back to October of 2022, maintains this upward trend channel and has moved back into the uppermost quadrant of that channel. Now, we started to bounce a couple of days ago, of course, on Thursday last week. That bounce came after the trounce from June 1st highs down to June 11th lows. We saw that entire move take the S&P 500 from the very top of that long-term uptrend channel to the center line. What typically happens when we get to the center line is the selling slows down, and we can see a bounce of some sort. What we said to members on Friday over in the active trader room and on WealthCharts was, hey, if the market's able to close above 74.15, and in particular above the 50% retracement line from June 1st highs to June 11th lows, which it, by the way, did. It closed at 74.35, several points above that key retracement line, that the likelihood would be a move up on Sunday night that can take us up to the 75.40 area or potentially all the way up towards the low 7600 area, i.e. where the all-time highs are, before we start seeing some softening. In fact, I put that in paper and presented that to folks over in the active trader room and shared that with folks in WealthCharts. Did this on Friday at around 10:45 in the morning to give folks some sort of a guideline to work with as they moved into a weekend where we weren't sure which way it was going to go with Trump's plans. Bottom line, we got the scenario for up correct. We are in that latter scenario where we come up above that 75.40 line and we make our way up towards the lower 7600s, upper 7500s before a likely turn back down. Now, why do I think a turn back down is likely? The removal of bad news is not the same thing as adding good news or incremental good news to the market. Expanding earnings is going to be required in order to really expand the PE multiple. It's just another way to say it. At this stage, you've got the S&P 500 rising. I've taken advantage of trades at 6 p.m. and onwards yesterday during the live market trading day today, and I've been successful using some high probability patterns to capitalize on each increment of the up in a methodical manner. I'm going to share with you some of that insight right now. I take the triple S indicator, which is one that I've developed that helps us understand swing signaling on a day trading basis and short-term, long-term swing trading basis as well. I understood that we were in a buy signal state as of the 11th of June. That's the up triangle there. Understood that the 4-hour chart was trying to migrate its way up and above the MSR channel, but was not in a buy signal state as of that point in time at the end of the week last week. The 1-hour chart was in a buy signal state, and that buy signal state has been in place all the way since 1 p.m. on the 11th of June, where we got that big rush up and the continuation with the double green dots and, of course, the gap up on Sunday night, the 6 p.m. gap up, and the double green dots remain in play and price action continues to hold the speed lines. Now, we've had a little bit of softening, more sideways action than anything else, really since post noon, if you will. And we've had the market give us a little mini double top, a pull back into the MSR channel, a bounce back up. I was able to take advantage of the ride down, which is, of course, coming to you with the Triple S pre-trade conditioning setup, where we have a minimum of 3 signals. And then we get the double red dots with price action below the MSR channel, and then down the hatch it can go. I wasn't expecting a whole lot out of it, but I did trade it live in front of folks over on WealthCharts in the middle of the day today. I was able to do well overall on the day. I'll share some of those results with you. And of course, past performance is not indicative of future performance or future results. But in the 1, 2, 3, 4, 5 accounts that I've been trading on the day, I've been able to gross just over $3,750 in my prop accounts over here. And of course, All trading is at the independent trader's risk. Past performance is not an indication of future results. But when you follow the rules with the tools and you do that more consistently, well, it tends to work out more often than not. And that pre-trade conditioning pattern certainly helped with a little short side trade when predominantly all of my trades since 6 p.m. last night, Sunday futures open, have been on the long side. Now, where is this market going? Again, I'm going to just make it as simple as I can. I think we're headed up to where this red line is, which is a set of nested volume point of controls in the lower 7600s. We could get stifled in and around the 7590s, which we're not that far away from. Pause in that area, consolidate, maybe have a negatively divergent higher high, or push back down directly from there. The signal line that would give me confidence that things are starting to come back down again is 7540. 75.40 and then 74.80. Those would be the two numbers of most importance for those that are looking at downside risk potentially materializing. I wish you a wonderful rest of your trading day. We still have 2.5 hours of live market action to go before this auspicious day in markets comes to a close. Watch out on Wednesday. It's the Federal Reserve, and they may be a little bit more opaque than past Feds have been, which could cause some consternation in markets. But I hope to see you in videos just like these well before then. Have an incredible rest of your day, and we'll see you on the flip side. And thank you for watching. Bye for now.